Right now, the crypto markets are in complete free fall. Bitcoin is going through a sharp correction. Ethereum has been pulled down with it. Altcoins look like they've been hit with a sledgehammer. And the dominant question across the entire industry is the same one we've heard in every major drawdown. Is this the top of the cycle, or just another violent reset before the next move higher? This week, Tom Lee released one of his most important updates yet. Instead of repeating the usual 4-year cycle narrative, he breaks down a very different explanation for what actually drives Bitcoin, why Ethereum remains fundamentally strong despite the price action, and how tokenization is about to reshape global markets. In this video, we're going to cover 4 main sections: why the classic 4-year Bitcoin cycle doesn't hold up anymore, what really caused the recent crypto crash, why Ethereum might be entering its breakout era, how tokenization and AI form the backbone of the next financial system. Let's start with the foundation, the true cycle behind Bitcoin. For years, the industry treated the 4-year cycle like scripture. Halving occurs, Bitcoin rallies, then we get a year-long bear market. Repeat forever. But if you look closely at the data today, that narrative doesn't explain Bitcoin's behavior anymore. Too many things in the real world also happen in 4-year rhythms: elections, global events, business cycles. Matching the calendar doesn't tell you much. And if you want to stay ahead of a market to spot when it's heating up or flashing those rare buy signals, join the Crypto Nutshell, my free 5-minute daily newsletter. You'll get quick, actionable insights and the latest news that actually moves markets, all delivered straight to your inbox every single morning. Just hit the first link in the description and enter your email to join. All right, let's get back to the video. Tom breaks this down by examining 5 separate explanations for Bitcoin's cycle: the halving, monetary policy, retail speculation, the copper to gold ratio, and the business cycle. Here's the part where he lays out the framework.
So that gets us to copper versus gold. Someone on Twitter posted this, named AOBTC Analyst, and I thought it was interesting. This is saying, is there a copper-gold ratio marking Bitcoin's relationships? Here's why that's interesting. Copper versus gold is a measure of industrial activity versus a fixed monetary base. So when industrial activity is peaking, that's a high copper to gold ratio. Could that signal a peak in Bitcoin's prices? Well, let's overlay that chart. And if we look at the peaks in that ratio, in fact, it does correspond very well with the peak in Bitcoin prices. So I think that this is actually very explanatory, but look at the current ratio. It's not signaling a top. And let's think about ISM manufacturing along that same line. ISM is really the most important measure of US industrial activity. When that index is above 50, the economy is expanding, and when it's below 50, it's in contraction. So the business cycle peaks are marked here. Current reading is 48.7, so the ISM says we're not solidly in expansion territory, and of course nowhere near a peak. Well, how does that compare to Bitcoin's price? If you look at the peak in the ISMs, they do correspond really well with Bitcoin's peak in price. In fact, 4 times the major highs in Bitcoin's corresponded to an ISM high. But ISM is not signaling a top currently. It's still well below 50. So here's our take. I think the halving cycle worked in the past, but I think there's too many things that are 4 years. The monetary policy cycle really doesn't explain the 4-year cycle. It explains Bitcoin in the short term, but not on a 4-year basis. The speculation cycle doesn't really work because it only explained 1 of 3 margin cycles for Bitcoin. But this gold versus Bitcoin versus copper, yes, it does seem to really be explanatory, and it's telling us we're not really near a top because industrial activity isn't peaking. And then finally, when it comes to the business cycle at ISM, I think it is actually quite explanatory, and again, not a sign of a top. So our takeaway is the Bitcoin price cycle actually seems to follow industrial activity and gold. And the message currently is HODL. I wouldn't be giving up on Bitcoin and assuming the price has already peaked.
The critical insight here is that most of the classic explanations fall apart when you line them up against Bitcoin's actual price history. The halving doesn't consistently predict tops. Monetary policy affects shorter-term moves, but not multi-year peaks. Retail speculation matters, but it doesn't map cleanly to cycle endings. The 2 metrics that do line up almost perfectly with Bitcoin's major peaks are the copper to gold ratio and the ISM manufacturing index. Both measure the same thing in different ways. Industrial activity. When industrial activity is booming, the copper to gold ratio spikes and ISM pushes above 50. Historically, that's exactly when Bitcoin has topped out, not because of halvings, but because the entire economic machine is running hot. And here's the important part. Today's readings show the exact opposite of a cycle top. The copper/gold ratio is not signaling overheating. ISM is still below expansion territory. Industrial activity is nowhere near a peak. So Bitcoin's current correction isn't behaving like the classic end-of-cycle exhaustion everyone is expecting. If anything, the macro signals suggest that industrial momentum hasn't even kicked in yet. That means this drawdown is far more likely to be a mid-cycle flush, not a final blow-off top. It's messy, it's painful, but structurally, it looks like a reset inside a larger expansion, not the end of the road. Now let's address what everyone is actually feeling right now. The sudden collapse in crypto prices. Ethereum stuck in a big range. Bitcoin slicing down. Altcoins obliterated. Liquidations piling up. At first glance, it feels like something fundamentally broke. But Tom gives a very different explanation, and it lines up almost perfectly with the behavior of the order books over the last few weeks. This is how he explains the sell-off beneath the surface.
Ethereum is continuing to trade in this large base, as we're highlighting here. But as you know, crypto suffered a massive liquidation on October 10th. And we pointed out that the languishing of crypto prices in the past 2 weeks, since October 10th, has the signs of a market maker, or maybe more than one, having a problem with their balance sheet. That means they need to raise capital. They're, of course, not taking risk and providing liquidity to markets. And of course, that means sharks are circling because they know there is price vulnerability. They're going to try to force prices down because that would create further problems. And that's where the asymmetry is. Until the market makers fix their balance sheets, and that takes time, sharks are circling. But this is the message to me. I just wouldn't be using leverage. I don't think this means crypto is broken. And in fact, as you can see on CoinMarketCap's Crypto Fear and Greed Index, we're at an extreme fear reading right now. These are levels that you saw at the April tariff lows. So I don't think this is a time to be panicking. And of course, positive things keep happening on the blockchain. This is Ethereum's block space at an all-time high. Of course, stablecoin creations on Ethereum are an all-time high, and many crypto experts are talking about why Ethereum is really where a lot of people are building.
This is the dynamic most investors underestimate. When a major market maker or liquidity provider runs into balance sheet issues, they step back. They can't take normal levels of risk. They stop filling orders they'd usually absorb. That immediately makes the market thinner. Once that happens, aggressive traders, the sharks Tom refers to, push into the weak spots. They know a stressed counterparty is out of position. They know liquidity is fragile. And they know that forcing prices lower can trigger even more liquidations. That's how you get cascading sell-offs even when the fundamentals haven't changed. The Fear and Greed Index confirms this. We're back at extreme fear, the kind seen during tariff scares, policy panics, and liquidity shocks. Those readings don't happen at exuberant peaks. They happen when forced sellers dominate. This sell-off wasn't a cycle top. It wasn't a macro unwind. It wasn't the industry collapsing. It was market structure under stress. And in this kind of environment, leverage becomes the biggest risk in the entire market. Even a correct thesis can get destroyed by thin liquidity and a wounded market maker. If you zoom out, the story here isn't crypto is breaking. It's crypto is being temporarily distorted by impaired liquidity providers. There's a huge difference. With all the focus on Bitcoin, Ethereum has become the sleeper story of this cycle. Price has been hit hard, but on-chain activity tells a very different story. Ethereum block space is at all-time highs, stablecoin creation at all-time highs, developers concentrating on Ethereum. Tokenization experiments are accelerating, real-world assets increasingly choosing Ethereum rails. Despite all this activity, Ethereum remains undervalued relative to Bitcoin, at least when you compare it to its long-term Ethereum to Bitcoin ratio. Tom makes a strong comparison that captures what's happening. Here's how he positions Ethereum right now.
I think Ethereum in 2025 is having its 1971 moment. Many companies are building projects on Ethereum, and most of the value in terms of tokenized assets are taking place on Ethereum. And that tells me that Ethereum's price to Bitcoin ratio should start to get to at least its 8-year average and probably get to an all-time high. And that means that if Ethereum gets to its 8-year average price, that's about 12,000 Ethereum. So Ethereum is really undervalued currently. And if it gets to the 2021 high ratio, that's 22,000 Ethereum. And of course, if Ethereum becomes the payment rails of the future, that's $62,000 Ethereum. So you can see Ethereum at its current prices is drastically undervalued.
The 1971 moment is more than a metaphor. In 1971, the financial system abandoned the gold standard and entered a phase of explosive innovation: electronic trading, derivatives, new monetary tools, global liquidity flows. Ethereum is entering a similar structural transition. It's becoming the settlement layer for a future where assets are programmable, fractional, and traded globally around the clock. And if you look at the ETH/BTC ratio over the last 8 years, Ethereum is trading well below its historical norms. When fundamentals rise and price lags, the ratio doesn't stay depressed forever. If Ethereum simply returns to its long-term average relative to Bitcoin, the repricing would be significant. If it regains prior cycle highs, even more. And if it becomes the dominant settlement layer for tokenized assets, the upside is larger again. The numbers aren't the point. The structure is the point. Ethereum's price does not reflect its current level of utility or future role. That gap doesn't close quietly. It closes violently. And that's why this moment matters. Ethereum is quietly strengthening while sentiment is collapsing. Historically, that combination produces large moves. The final piece of Tom's message ties all of this together. Tokenization is one of those words everyone uses, yet almost no one explains properly. The version most people talk about is the shallow version: put assets on a blockchain and call it innovation. Tom goes much deeper. He describes a financial system rebuilt from first principles, and this next section shows what tokenization actually looks like in practice.
And that gets us to the third topic, which is tokenization. Now, you've heard a lot of people talk about tokenization, but I want to explain why it's a huge unlock, okay? Larry Fink says we're at the beginning of tokenizing all assets. I mean, he's talking about stocks, bonds, and Vlad at Robinhood is saying the same thing. Now, there's 5 reasons why tokenization is important, okay? It's fractional ownership. It reduces cost and efficiency for managing securities. Therefore, it's better for the investor. It allows 24/7 global trading. You get a lot more transparency and security, and hopefully over time you get increased liquidity. So what does this mean? Well, it means that in 1971, Wall Street was in its earliest stages of innovation. We are here today, 2025, but tokenization on Ethereum is going to take us into the future. So what is tokenization? Let's just take a Rembrandt painting to illustrate. And to tokenize it, we can break it into its components. And in theory, someone could just say, if they're doing fractional ownership, they just want to own this part of the Rembrandt. Okay, that is fractional ownership. But you can also factorize on the blockchain. And what does factorize mean? Well, it means taking the painting and then breaking it into its base colors. Okay, and therefore you can do that with a business. Let me give you an example with Tesla and unlocking Tesla by factorizing it. You can time tokenize Tesla. That means you can buy the earnings on a specific date in the future. You can product tokenize. You can buy the present value of a specific product stream. You can even geographically tokenize. You can buy the present value of a regional portion of Tesla's sales, or you can financial statement tokenize. Now, why am I pointing this out? You need liquidity to create these, but you also need smart contracts, a lot of good technology, and a lot of good code, and that's what's happening on the blockchain. So here's an example of time tokenization. Tesla's stock price is really the sum of all future earnings. And we know that, for instance, Elon's going to get a 10-year pay package worth $1 trillion if he delivers value for Tesla shareholders. Well, what does that mean? That means that you may only want to buy Tesla's earnings in 2036 when he gets the payoff. Well, that's an example of time tokenization. Now, there's a second way to look at this, which is product tokenization. Tesla is comprised of the present value of its various streams of EV, robotaxi, prime robots, FSD, solar, and of course, the future, which is Elon's brain. Someone may only want to buy Elon's brain, and therefore a tokenized Tesla is a bet on that versus everything else. So you get the picture.
This is where everything connects. Instead of treating a company like Tesla as one monolithic asset, tokenization lets you deconstruct it. Earnings in a specific year, revenue from a specific product, cash flow from a specific region, value of a specific unit, or even a single line item on a financial statement. Now combine that with smart contracts and programmable ownership. You can hold only the 2036 earnings, or only the global EV revenue stream, or only the solar division, or a fractional share of a physical asset broken into thousands of pieces. Real markets become granular, composable, and tradable around the clock. And here's where AI fits in. Once assets are broken down into hundreds or thousands of unique tokenized components, humans can't price them effectively. AI can. So the new financial stack becomes tokenized assets at the base, Ethereum and smart contract rails in the middle, AI-driven allocators and pricing systems on top. That's the real endgame. A programmable financial system with intelligent capital allocation happening at machine speed. In that architecture, Ethereum isn't just another chain. It's the settlement layer that the rest of the system plugs into, and Bitcoin becomes the macro reserve asset that tracks industrial activity and global liquidity cycles. Everything Tom described fits into this bigger architecture: Bitcoin for macro cycles, Ethereum for financial infrastructure, AI for intelligent allocation, tokenization for the next generation of markets. So, when you step back from the fear and look at the bigger picture, the story is much clearer. Bitcoin isn't following a halving cycle anymore. It's tied to industrial activity, and the metrics that historically signal major tops aren't anywhere close. This sharp correction is painful, but it's not behaving like a blow-off peak. The recent crash wasn't caused by macro failure. It was potentially caused by a stressed market maker, thin liquidity, and cascading liquidations. Ethereum is undergoing its own transformation. While price lags, usage, tokenization, block space, and stablecoin demand continue to hit new highs. Historically, price eventually catches up to that kind of activity. And tokenization, combined with AI, is building the rails of a new financial system where assets are fully programmable. The volatility is real, the fear is real, but the underlying structure is far stronger than it looks from the daily candles. If you zoom out and follow the deeper drivers, industrial cycles, liquidity dynamics, and financial infrastructure, this correction looks a lot less like an ending and a lot more like a messy chapter inside a much larger trend.